Good morning. Welcome to the Brew. Today, Thursday Traders Workshop. We got the lads on today, and we are going to talk about trading the big move. We had a big one the other day, big down day. So let's see what the boys do with their positions after the bell. Oh, we didn't get the okay.
Yeah, where's your rock, man?
I didn't have my rock that time. Hey, boys, how are you? So, yeah, trading the big move. We don't get tons of big moves in summertime from memory. I mean, it happens, but Mark, right? The dog days of trading back in the day, summer, very, very slow.
Very slow. Although we had some chop at the beginning of August this year.
We
that
did.
Was sort of I hope you didn't go on vacation already.
Yeah, I know. August is typically a very slow month because of that. Kids are going back to school. People are going on last minute vacations or end of the summer vacations, what have you. But we did have a nice move the other day. A nice, not so nice for people who are investors, but a big down move, right? You guys take any kernels out of that one?
Well, I mean, first of all, it depends on the time frame in which you trade. I think if you are a zero DTE trader and you're not holding overnight, you have to have a real good flow reason to either see a continuation or try to identify a place for a bounce.
Mm-hmm.
I typically tend to be more of a swing trader or a month-to-month trader, and I mean, obviously I rely on Volin very heavily for that. And, essentially like what I look for in Volin is aggregate Vanna positive or negative? And if it's positive, that means the default is going to be, we're going to climb, do that, slow plus 10, plus 15 points every single day.
Mm-hmm.
People start talking about how we have an 8-9 trading day winning streak, but each day is only like between 5 and 15 points, stuff like that.
Mm-hmm.
But then I also look to see if there's support below the market, and that's when I know I have to hedge, because if there is no support, like there wasn't over the past couple weeks, that's when you got to have a put.
Yeah. So let me ask a question before we get going too much further. What represents to you support? You said something, but you said positive Vanna tends to, or I'm assuming it's positive end of the upside, tends to indicate a grinder sort of environment potentially, right?
Yeah. So I'll tell you my assumptions, and then you guys as former market makers can nod yes or no.
Okay.
So first, typically dealers are not hedging all of their Vega, like barely any Vega, right?
Okay. Fair enough.
Right. And so, but because of that, implied volatility moves do have an impact on the deltas that they are going to see on their screen, the soft deltas of their whole book position. But if implied volatility goes higher, which is, what Vanna is measuring, if you have positive Vanna and implied volatility goes up, then deltas also go up, which means they have to sell.
Mm-hmm.
And that's why you have that spot vol correlation, the why VIX goes down when the market goes up and why VIX goes up when the market goes down.
Mm-hmm.
So when you don't have support, aggregate Vanna declines as the market goes down and makes it kind of worse. It cascades on the downside.
Mm-hmm.
In order to hedge that, a lot of customers on, what was it, Monday? When do we get the down day? Tuesday, I guess, right? Tuesday.
Mm-hmm.
In order to hedge that, there were a lot of put buys. A lot of customers bought tons of puts in September, option expiration.
Okay.
And that now gives support to the market. And now we're probably not going to have another day like Tuesday.
Don't say forever.
Unless unemployment comes in at like 5% or something, but
Okay.
So, I mean, that's what I look for is there going to be Vanna support under the market to prevent this kind of move? And if there isn't, then I know I'm going to have to hedge and prepare for these kind of moves.
Okay.
If you're a zero DTE trader, you just kind of look at the flows and see, is there support right now or isn't there? And that's,
okay.
Mm-hmm.
I got it. So, Mark, what kind of things are you doing, or I don't want to say recommend, but what kind of things do you think about on those massive down days like we had. I mean, I think NASDAQ, if I'm not mistaken, was down 2.5%. Was that?
Yeah, I think SPOOs were down 202, I think, just over 2%.
Yeah.
Mm-hmm.
So any kind of kernels of wisdom on those kind of days? I mean, we'll get into the market making side in a sec, but from a retail standpoint, I mean, my feeling is that folks have their dollar trade on, meaning they're looking for a dollar amount of sorts, not super directional per se.
Yeah, for sure. Well, I actually really like Jason's comment about depends on your time frame, and I think regardless of your time frame, you got to be prepared for a day like Tuesday. Like they happen enough. Like
Sure.
so, if your strategy is fragile to a day like Tuesday happening at a 0 DTE level or at a long-term level, you're doing it wrong. So I think on the long-term thing, that's simple. You don't do much. If you have a hedged equity, an overlay, a covered call, like there's not much to do if that's happening across most of those medium-term to long-term strategies. And frankly, on the short side, I'm less directional than Jason is. So I've actually been playing recently on the short side is some automated condor bots, opening and closing short-term condors. And there you do nothing with that. You collect 20 cents more premium on and you're collecting 72 cents instead of 50 cents on a dollar wide risk.
Okay, so I have a question about that now, because I kind of play in that little arena as well with the 0 DT and condors and what have you. What I noticed, I believe it was Tuesday, right? So you could definitely get into the market on an iron condor, and sometimes I leg these things, right? So I'll, in the big down move that we had, I think the SPOOs were down. When I say SPOOs, when Mark and I say SPOOs, that means the S&P futures. That's how we referred to it back in the day, SPOOs. But they were down like 88 or something like that, almost 90 handles. And I decided to get it on the short put side of my iron condor. So I did. Kind of ran up a little bit, not enough to get excited about. Then I put the call spread on. Everything was hunky-dory. Here's the problem, right? So I got in for maybe $1.50 on this thing. Pretty good breath. And before I knew it, we had a little bit of a rally before we really hit the bricks. And that 150 was 75 cents. Do you take it off or do you leave it go to the end? And that's the question I get a lot from retail traders. When do I take this stupid thing off and run for the hills? Because then they think, well, if I take it off for 75 cents, and it goes to zero, they're always thinking, I left 75 cents on the table, right? But in this scenario, had you not taken it off, it runs through your put strike if you're not crafty, and you go to $5 on this thing and you lose $3.50, right?
Yeah.
So any suggestions there? And my feeling is, before you say it, the 0 DTE folks are in and out like you just said. That's why I brought this up. They put their spread on, they get their 40 cents ish, out they go and move along. And the pattern day trading causes a problem, which we'll talk about in a second. But go ahead. Sorry.
So, okay, go ahead.
I was just going to say you get out of it the same way you get in. I like that you don't have to necessarily think of it as a package. Leg it out of it. If your put spread's cheap, buy that in. Leave your calls on. I think you can leg out of it the same way you leg in. In terms of a percentage number overall, I think you've got to see at least 50% profit in these, if not more, just because of what your losses is, because of that tail. I think you have to get at least that, and I'm usually even greedier.
So greedier meaning 60%,
70-80%.
Okay, but you're not letting this spread go to zero, right? Every 0 DT, and just say close your eyes, whatever happens, move along. You're not doing that.
No, I don't want if you can close these for effectively the ends up being I'm talking in SPY, you're paying nickels and dimes. So the fact that it's nickels and dimes in dollar space, you just got to get rid of that.
Okay. Yeah, I think I agree with that. I've been doing this experiment. So, and one of the other, Jason, before you go, one of the other problems is the pattern day trader problem. Okay. Needless to say, I'm not a fan. So I try to do this small account trading to prove that it can be done. And we're not going to get into it this time, but maybe it's a good topic for next time. But the way I end up getting out of these things in the small account is doing the box. So I do the opposite sides and I got to box out of it. What's the problem with that? Well, I get out of the trade and I can do all the math, and we'll show that next time, all the math works. But I've got 2 assignment fees now, right? So if I box 4 legs, I got 4 assignment fees. All of a sudden, at $20 a round turn on those, times whatever, it kind of adds up.
Well, not to mention the pin risk, right? Like,
well, I do SPX, so I don't have to worry about that because it's cash settled, right?
Oh, nice. Wait, so you're trading SPX, but you're in less than a $25,000 account?
Oh yeah, I want to prove because I got the gauntlet thrown. Show me how to trade this with less than 25,000. So
I think that's what SPY's for. I agree with you generally. I generally agree with you.
Yeah, but
I
think about
the Saturday trader rules are ridiculous. But.
Yeah, it's insane. And what I was thinking about when I'm doing this, and they're trying to protect the little guy, right? So I'm looking at this and I'm thinking, wait, I'm pretending like I'm a little guy, and I've got a great profit in it, and I can't get out. I can't take my profit. The government's preventing me from taking my profit. And who do they hurt? They hurt the little guy. I'm like, this is insanity. The big guys don't give a shit. Oop, did I say shit? Sorry. They don't give a crap.
FTC.
Yeah, they don't care. They don't care because I get so much money. I'm just getting it on. I'm making all my money and churning it and just killing it. And the little guy's going, I can't even make my profit. I can't take it. Right. So to me, that's silly. It drives me nuts. But that's another tale. But you got to use the box to get out of those things. So that's what I did was I teaching people how to do that box trade to lock it up. And SPX is good because there's never a question about delivery, ever. Right. There's no
that's very
risk.
nice.
There's no post. There's no pin risk. There's no out of expiration risk or after the close risk. That's the beauty of it. You trade 10 times the product, but still you just trade less. Right.
And your 60/40 tax treatment pays for some of those assignment fees.
That's right. That's true too. Good point. So anyway, that's what I was getting at when I just get angry when I'm sitting here going, oh, good. I'm glad they're protecting the little guy. I can't get out and make my money here. This is wonderful.
Yeah, they treat you like
the poster boy of the little guy. You are absolutely the retail trader that they're trying to protect.
Yeah, I know. You're hearing my little violin on my shoulder going like this, right? Oh, I feel so sorry for Lex. Idiot.
Small violin.
All right.
So
anyway, sorry. That was my my speech.
We got the Lex rant.
I had a rant. That was my rant.
So I've spoken a lot with, as even a retail trader myself, or retail, I guess you could say, class of trader. I'm professional, not investment advice. I kind of see 2 real sources of success in the markets. The first one is having like real verified flow edge. That's kind of most of the stuff of hedge funds and institutions. They're trying to find that flow edge. They're all gathered up in their Bloombergs and talking to each other. Hey, are you buying? Are you selling? And, it's like a kind of a massive poker game there. But technically with retail and kind of what I hear you guys talking about with your condors, our source of success is more about trade planning and risk management. Even like technical analysis where people think that they have some kind of insight into the market because it hits trend lines or whatever. Really, that's a trade planning exercise. It's, I'm trying to limit my losses based on, historical kind of patterns and stuff like that.
Right.
And I think that really the biggest takeaway from a day like Tuesday is if you lost big or something, if you left your condor on and you say, my trade plan is to put on this condor and leave it on to the end of the day.
Yep.
For reasons, whatever reasons you have.
Sure.
And you lost money, you kind of need to alter your trade plan. And for the retail,
do you alter it after your first loss? Is it you lose 10 in a row? When do you alter it?
Well, I think ultimately your trade plan is something that has to evolve. Like when you see something like a trend 2% down day, like it was, with only the largest bounce was at the end of the day. You kind of have to evolve your trade plan and say, oh, these days happen. If you didn't plan for it before, now you kind of have to plan for, I won't let, for some reason, I won't let this go down more, or I won't let my losses pile up to this point. And, go and back test what you have, back test and see if I cut out at my long strike on my condor, say, am I, what are the chances that the market recovers? Like how often does it recover? And you can, you're going to have to back test it. Trading is a lot of work. It's a lot of, especially when most people don't have access to, very in-depth edge. Voland is, kind of verified data edge, and that's what I trade on. But most people, if you're not using that, you're relying on your trade planning and you're relying on history. That what is the scenario that you lose the 375 or whatever, and do you make more on your little gains in your condor? When do you take it off? When do you leave it on? When do and you kind of have to have that trade plan all set out. I have a feeling you might not, Lex, but
No, I think, listen, I preach that, all the time when I speak around the joint, and I think that's an important point. I'm a massive fan of a trade plan. And the problem I find, especially in the retail community, and look, I'm guilty of it sometimes too. You're always second guessing your trade plan when it pushes you, right? And you're like, oh, it's impossible that this is going to keep going down. What am I doing? Kind of thing. But, and that's why I'm such a fan of automation, but another time. But you're 100% right. If you don't have a trade plan as a retail person, you are dead. I mean, you are cooked. You really have to follow it to a T, and it better be pretty good too. I agree with that. And I like some of the
risk management can go.
Sorry, go ahead, Mark.
Can go so far as being a positive edge, like really good risk management, like is a positive edge in and of itself. No risk management is absolutely a massive negative edge.
Correct. Yeah, I couldn't agree more. And look, so
or trading from the gut, definitely.
That's no good either. That's what I like to do that a lot, trading from the gut. I think Netflix has gone too high. I'm going to sell something. I just feel that. That's my trade plan. But I think though that as a retail person, in democratization of markets and costs and everything, you can just get in anywhere, right? It's easy. That's the easy part, in my opinion. It's the tricky part. And we always taught our traders this back in the day. I can hire anyone to get into a trade. Be fast, get in. What you do with it after that, that's the skill, right? And the trade plan's all part of that. On the trading floor back in the day, we taught so many ways to get in and out and manage your inventory and your risk. And I think we don't see enough of that in the retail world. I don't think we're teaching enough of that.
Yeah, I think there are a lot of trade planners out there. There's a lot of income traders kind of thing where I am selling this put spread every single month. And, but I don't think that anybody actually teaches you how to trade plan. They just try to gift you a trade plan. And I don't like that so much myself. Right. But as I was saying though before, I mean, we personally the way I trade is via Voland, and I had a short trade on getting ready for something like Tuesday. I thought it would happen after probably Jolts or Friday maybe, but it happened earlier. You asked for like tips and tricks. One of the kind of tips and tricks I use that I've made it popular on Twitter. I've even tweeted about it on, I guess, Wednesday. But on Tuesday, when we dropped 2%, as I kind of mentioned before, there is a spot vol correlation. And typically that correlation is about 0.7 VIX points for every 1% of SPX. Okay. So if SPX goes down 1%, typically VIX goes up 0.7, right? Okay. Give or take. It's a linear kind of thing.
Yep.
If it deviates 2 points from that spot vol correlation, SPX went down 2% and change, a little bit. But VIX went up like 6. It went up a lot. Typically what that means is that there has been some put support put on, or there's a liquidity problem. We have in Voland, we have metrics for both. You can determine what happened. On Tuesday, there was a lot of put buying. Liquidity didn't actually change all that much. But when you see that's like put buying, VIX shooting up to the sky, that's a time in which you can play for, on a swing basis, play for a bounce. Historically, 14 out of 15 times over the past several years, including 2020, we have bounced back to the origin of the move when I call it over-VIXed by 2 or more points.
2 or more points over VIX. Okay.
So now
Got it.
on Tuesday, though, is a little bit of a kind of a squishy point because
You say squishy?
There is something squishy. On Mondays, typically, VIX is usually up a little bit more than it's supposed to be because the weekend has passed, and VIX is usually down a little bit more than it's supposed to be on Friday.
Traders are taking the weekend out as Friday rolls along.
They're waiting the weekend, right?
Okay.
WEIGHT, waiting the weekend.
Yep, I got it.
When it's a long weekend, it tends to be more, VIX. So there is kind of like that question, but even if I added an extra VIX point, which is usually a lot for a long weekend, we still over VIXed on Tuesday. So I think it's a decent play to play for a bounce at this point. There is a little bit of support now underneath the market, but it's only until September OPEX. So, I mean, if we bounce, it could get up as high as about 56.50. It might start happening on Friday if unemployment comes back, somewhat stable.
Right.
And then you have FOMC also before OPEX. So.
Right. So you're kind of looking for a little bit of a grinder. Maybe not even a grinder, maybe a little more.
There'll probably be like a sharp bounce and then grind.
I gotcha. Okay. Yeah, because we're at the S&Ps are at 55.40, let's call it, give or take. So that's a pretty good move up to 56.40.
We jumped a little bit today.
Yeah, we're up a little bit, 20-ish. Now 20. So, Mark, what are you doing with your stuff? Anything different from Jason from your angle? Non-market maker-esque sort of stuff?
No, I mean, I would, like I mentioned before, it's my angle these days in the short-term stuff are these condors and these automated condors that are just getting in there, some take profit rules. And in a lot of ways, that's its own trade plan. And you've got to adjust some of your settings. And, I think there's some sauce about when you do want to do it or not. Like, I do think there's a discretionary layer to some of that risk management. FOMC days, are one of those, it's like, why trade on that day? No matter how fat the premium is, I don't trade on that day.
Yeah.
But
that's a good point. Short
month vol goes up, the front part of the curve, you're selling 24 vol instead of, 18 vol in SPY. That condor goes from a dollar condor goes from 50 to 70 cents. That's a lot more collection. So I'm happy to sell on those days.
Yeah. So those are great points. And I love the point of not trading on FOMC days, which I haven't learned quite yet because I never look at the news calendar. I just throw everything on all the time.
And it always looks so juicy, and it's always obvious what's going to happen with CPI and what the market's going to do.
Right.
But you
hold on, get out. Yeah, that's my game. Is there any advice, either one of you, sage advice for the iron condor people to indicate that it's probably a good time to do this? And what I'm getting at here is implied volatility levels in SPX. Let's just talk about SPX generally. Implied volatility level in SPX, you get more for that 20 delta condor than you do in a low volatility environment. You know what I mean? Is there a magic sort of calculus that goes on in your head that is telling that now's the time to do one of these babies? Don't jump at this.
Oh, Mark is the one that does it, but I'll give you my
I'm not saying there's an answer here, by the way. I mean, my answer is that, obviously I want to sell high volatility. Okay. I want to sell something that's juicy and dear. I don't want to be selling really low volatility generally. Okay. So I like to sell it higher. And then, what I always show people is that, when you have an expected move in a low volatility environment of 20, all of a sudden in a higher volatility environment, that might be 40. Now, all of a sudden your 20 delta has gone from, a few strikes away from at the money to several strikes. Reasons for that: higher volatility means bigger moves. Right? But you do get more juice for it and you get paid a little bit better for it. And if you're in the game of taking 50-ish% out of that iron condor, it's got a day to live, man. You probably get that thing on at 10 in the morning and get it off by 1. You're in good doo-doo. Right?
I mostly agree with you, but I'll take the other side for argument's sake.
Good.
Is that I think one of the things, selling higher volatility is great. Like I said, I prefer 70 cents over 50 cents on a dollar spread. That's obviously a lot better risk reward profile. But I wouldn't ignore the win rate component of that. And that getting a lot of little wins adds up pretty quickly compared to 1 or 2 of those home runs that you're going to remember. So
Right.
like if things start to get spooky, like yeah, the premium's fatter, but that's also a good reason to back off because it means no one knows, what's going to happen.
Yeah.
And so you might feel really good collecting that premium, but look at how often you're winning when nothing's happening and you are collecting low premium too.
Right.
Because it sometimes is worth staying out when there's too much trap on that.
Yep. Yeah. I think that's all good. Sometimes I go the broken wing double butterfly. Oh, what?
Isn't this the Wonder Woman? Have we branded that yet?
We haven't, but it looks like a Wonder Woman. It's like a little W.
I thought it was Batman.
Yeah, it could be Batman. Yeah, the Batman.
Well, I guess it depends if you're long or if you're short.
Right.
Yeah, there's too many legs there. You might as well just get a condor.
Yeah.
Well, the thing, so personally, I mean, I use Voland. Like if I were to do a 0 DTE strategy using options, my first thing I would do is I would look at Voland and say, is this kind of like a regime that is calm? Is there going to be some kind of news event? Am I expecting implied volatility to go up or down? Right now, realized volatility, with the exception actually starting on Tuesday, realized volatility has been higher than implied volatility on a 0 DTE basis, mostly since August OPEX. We've, your straddles have cost, $25, and we've had more $25 days, 25-point days to 30-point days than really one standard deviation has implied. So ultimately, that's what I would look at personally. Is realized volatility matching the straddle prices? And if it is, if realized volatility is lower than the straddle prices, typically, over the past week, you could even say, then if realized volatility is lower, put on the condor. If it isn't, you might want to go long gamma, buy one of those straddles or, something like that.
I know that's hard for me to do. It's like a cold plunge. Hard for me to get in there when implied volatility is high and me buying it. It's very hard to do. I know what you're saying though. If realized is higher, technically you should make money. The music shouldn't stop and you have to get in a chair. So
right.
All right, good.
But winning on a gap feels pretty good. Winning on a move does feel good.
100%.
Like skating is one feeling of winning, but winning on a move does feel good.
You're right. The payoff is so much prettier and so much nicer. Sometimes I forget. Like I do a lot of double calendars in low volatility environments, right? So I do a lot of those double calendars. Kind of space them around my expected move. Sometimes the shorts roll off and I haven't gotten out because I didn't make enough money. And I've got the too long strangle. I got a strangle now in the back month, and I forget I have it on. And I get a big move. I got it in NVIDIA the other day after I did an NVIDIA spread. I look at why is my account up so much? I go, oh, there it is. I forgot about that little put I had, solo long put out there. It feels so good when it happens, but it just hardly doesn't happen enough. I don't think.
Oh, Lex,
never sell your nickel.
So your trade plan is forget I have it on.
Well. So I know what I can lose. I did these things for 30 cents, and I already in my mind, my trade plan was I'm willing to lose the 30, 40 cents in the double spread. They were so cheap. And I'm like, okay, if it goes to zero, it goes to zero. But I forgot because it was part of my trade plan to forget. And put one out on the wall out in Wrigley, man.
Love it.
Oh my
God.
You need to post that.
Don't listen. Don't do what I did.
Oh, but that being said, AVGO is today.
Oh God, not another one of these. I got to look at this now. AVGO. I'm writing it down. AVGO.
Broadcom. Yeah, that's another AI play.
That's probably a pretty good. And that one might have some liquidity. I'll look at that one.
It will.
Okay. All right, boys, we got to go. Good talk.
All right.
I love it. Good topic, Mark. What else? Next week, Thursday. Oh, Mark up top, harvestedfinancial.com. He's doing all kinds of new stuff. I know Jason's always doing new stuff. Jason at vol.land. Okay, there you go. You got some things.
If you want a trade plan around real verified flow edge, come to vol.land.
There you go. And if you want to learn about trading and French wine, you've got Harvested Financial too. Mark, plug as needed.
He's got a good dashboard too.
That's right. I love it. You guys both have good dash. It's a hell of a dashboard you have there, sir. All right. And then don't forget about the summit, September 18th. Jason's mad because I didn't include him this year. this time. But don't worry, kid. You're gonna have it. You're gonna get there. We're gonna get you there. September 18th starts at 10:30 a.m. Eastern. Yours truly will be hosting, and we have some great stuff. We're going to talk a little bit about this too. So, big moves, election events, geopolitical events. How do you position? How do you do? What do you do? Blah, blah, blah. So, September 18th. You guys have a great weekend. Anything else? Good?
Happy trading.
Happy trading. It's a wrap. See you guys.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by SIBO, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.